Hello, my name is Cantrell. Thank you for joining me for this 5-minute presentation on lean accounting. Lean accounting has been around for a long time. Around the turn of the 20th century, Toyota came over from Japan to visit with Ford to see all the things that they were doing, from their assembly line to production to how they handled accounting to how they handled sales. Everything that Ford did, Toyota took a note on. They took it back to Japan and they began to address everything that they were doing, and they created their lean company. And lean accounting was perfected out of this. Now, lean accounting does exactly what it sounds like. It makes things lean. It takes away all the fat, it takes away all the excess, it takes away all the weighted things that really don't count for what is going on in the accounting world. It also makes it where it's legible for managers to read on all levels of the company, and really even legible for some of the employees below them and the managers to at least be able to explain how it goes. But there's a huge difference in lean accounting and traditional accounting. They don't really flow side by side. There's a major differences. Here's some of the differences they have. Lean accounting is more of a value stream, that everything flows and everything stays together. Traditional accounting has more departmental. Everything's got its space, everything's got its place. Like, let's use this as an example. Every department has its own budget. At the end of the year, the IT department looks up, they have 1 month left in the physical year, and they realize they have $10,000 in their budget. Well, they don't have anything really pressing, but they decide they need to spend this money or they'll lose it next year. So they say, we'll buy a couple computers, we'll buy some charge pads, we'll buy some mouse pads, we'll buy some extra chairs for some of the guys in the office. Everybody on the desk gets a new stapler. Different things like that. When you look at the end of the month, all they really did was waste $10,000 of the company's profits. In value stream, that's not the way it works. Everything flows in the same stream. And so the guy in IT comes up and says, hey, I need a computer, a new laptop for this salesman. No problem. They see the value and they can do it. That's how the value stream works. In lean accounting, there's more of a flow and pull idea through production line. The flow and pull means as soon everything continues to flow, all inventory, all products continue to move. And pull means as soon as it comes off the line, as quickly as they can, they get it on the truck and get it to the customer. In traditional accounting, inventory is seen as an asset. This is not true in lean accounting. It's not an asset. It's not valuable until it's sold. Well, if inventory is seen as an asset, there can be a problem of overstocking. The manager for manufacturing looks and sees he has a lot of raw material left. With this raw material, he takes the opportunity to take a negative in raw material and make an inventory into a positive. And now he's overstocked. Now there's a different negative that comes from the labor side, because now they have to move the material around. Now he has different needs for maybe a forklift, for maybe other employees to move the material, to move the inventory. This becomes a problem for the company, but it's not the manufacturer's problem. It's in another department. And then in lean accounting, the value is the customer. Really, all the ideas start with the customer in lean accounting. The customer has this idea that this is how he wants to use whatever widget that we may be selling or producing or making. And they tell the designers, and then they go to production, or then they go to the engineers, and then they go to production, and then it goes to marketing, and then it goes to the sales, and it goes all around the circle, and it gets its value again when it gets back to the customer. The customer is the most important part in lean accounting. Well, in traditional accounting, the product, it's product focused. The product is very, very important. Take the example of steering wheel. Say our company produces steering wheels, and we have on the steering wheel, we're very concerned about safety. That's important. We're very concerned about driver distractions. So we have all the buttons to control the radio, to control maybe the air conditioning, the cruise control, and different things that control the steering wheel. And these are all good and very valuable, not just for our product, but to the customer. But then there's also the ideas that somebody comes in and says, well, I know how to add value to our steering wheel. What if we make a gold-plated steering wheel? Now that sounds kind of silly. Why would they do that? But if the value is in the product and not the customer, then we begin to lose sight of what actually makes products and revenues and makes our products sell. The final thing in lean accounting I want to talk about is that lean accounting empowers our employees. The box score that they give is so much easier to read, not just for the accountant, but also for the manager that they give this area to. And they show them what can be done. Every person can see where they fit on this box score. On a balance sheet, Sometimes the only person that knows what that stuff says is the accountant, and sometimes the accountants have trouble too. And really, these balance sheets are made for those investing into the company, for those outside to see what is really going on. I don't know if lean accounting is for you and your firm or you and your corporation, but I think it's valuable and can be seen how it can benefit your company. Thank you for your time. Have a great day.